you want to have a fresh set of eyes or a fresh review of your insurances, not only your homeowners, but certainly your auto and your other protections as well. But with homeowners specifically, heading into retirement, things are changing. Perhaps you have a change in your needs. Perhaps your insurance hasn't been reviewed in a long time, and there's adjustments that need to be made.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back, everyone. I'm really excited this week. Have a special guest, Matt Dzubin with Roland Dumont Insurance, located in Bristol. Welcome, Matt.
Thanks for having me. Excited to be here.
Yeah, me too. Matt and I go way back. We know each other, I think, from middle school. We used to battle it out playing pickup basketball. Now we battle it out playing golf. He still wins.
Nah, I don't know about that.
So I have Matt on here today because the focus is to talk about things to consider about your property casualty insurance as you're approaching retirement. And we're going to focus on what you should know about homeowners insurance, car insurance, as well as some other things that you might not think about. So Matt, tell us a little bit about yourself, how you got into being a property and casualty agent.
Yeah, sure. So out of school, I was originally looking to get into the technology field. So I started with the Hartford Insurance Group in Southington, and insurance just kind of morphed into my life. And from there, I have grown to transition into primarily a sales agent role. And yeah, so it wasn't necessarily planned, but it's been a great blessing. I've been in the industry for about 20 years. I have 3 children who I chase around and a beautiful wife who puts up with me. And yeah, been doing that insurance for 20 years. And like I said, it's been great.
If you think about the typical homeowner going into retirement, what should they be aware of about their homeowners insurance as they approach retirement?
I think one thing that I'll probably repeat a little bit as we go through these topics today is that you want to have a fresh set of eyes or a fresh review of your insurances, not only your homeowners, but certainly your auto and your other protections as well. But with homeowners specifically, heading into retirement, things are changing. Perhaps you have a change in your needs. Perhaps your insurance hasn't been reviewed in a long time, and there's adjustments that need to be made. You know, one common thing is you've been putting up with the same kitchen for 20 years, and the kids are now gone through college. You paid for college, hopefully.
Hopefully, right?
Now you want to address that kitchen. Well, if the insurance was originally written based off of having Formica countertops, and now you're putting in quartz, you just want to make sure that your coverages are properly addressed and that your needs are met. So those little types of adjustments can be done, and they can be done very easily with a conversation with your insurance agent.
Yeah, that makes sense. That's something I never even would have thought of. So I guess making home improvements, you definitely want to, I guess you're increasing the value of your house, make sure that your coverage is reflecting of that.
Absolutely. And not only that, but you've seen and you do see the cost to rebuild, for example, go up over the course of time. And if you haven't addressed or taken a look at your insurance policy in a while, it's best to review it with your agent to make sure that your coverages are in line with what your proper replacement values are for your home. That's a very simple conversation. Most companies and agencies use very similar software to determine replacement values with a home. So those are all based off of what the current market conditions are. For example, the cost of lumber, which went up like crazy over the last year, and a piece of plywood now costs $100. Well, how's that going to impact you if you have a fire and you need to rebuild?
Yeah, you bring up a good point. So does the typical homeowner's policy adjust for inflation, or is that just a fixed amount that what you have is what you have?
It's a really good question. And the answer is that most companies have a form of their product that's going to include what's called inflation protection coverage. And it's basically a hedge so that if you purchase a home for $300,000 today, and that's the insurance value, let's just keep it really simple. The insurance value is $300,000 today. That's the estimated replacement value. That next year, when you get your insurance renewal in the mail, you would see an increase of approximately 4%. And that would bring that value to $312,000 for next year. So you'd actually see your insurance coverages increase a little bit. If you haven't had your insurances reviewed in a long time, the danger is that that house that you bought for $200,000 15 years ago, if it's still being written at $200,000, then obviously you have a shortfall of coverage. So this is a very easy subject to address. And like I said, most companies have some form of that coverage, and it's usually built into their better product lines.
Okay. So in that scenario, let's say you didn't address that and you had a total loss on your home. What would happen? You would just get the amount that you originally signed up for? Or?
Yes. I mean, in that scenario, there would be a danger that you would have a shortfall of coverage. I mean, with any of these coverages, I'm sure we'll touch a little bit on the liability aspect of things. But on property, if you have a set coverage limit, unless you have other additional features loaded into that policy, usually to qualify for those additional features, like expanded replacement cost coverage on a home or guaranteed replacement cost coverage on a home, not to throw too much insurance jargon at you, but basically what that means to you as a consumer is that if there's a fear of having a shortfall of coverage, that can be addressed by those additional features of a policy as well. Well, the thing is if you have a really trimmed down version of insurance, then not only will you miss out on feature one, you're going to miss out on feature two as well. But generally, when you have a good setup on your insurance and you've reviewed that with your insurance company or your agent and addressed these types of concerns, then not only would you have the inflation protection, but you'd also have some form of replacement value, expanded replacement costs or guaranteed replacement costs on your home. So if there was a shortfall of coverage, it could be addressed by those additional features within your policy.
Okay. What about flood insurance? Is that something that everyone should have, or should you just have that if you're told you need flood insurance?
So with doing this for 20 years, flood insurance is a little bit tricky because typically when consumers are coming to me for maybe a new home purchase and they're looking for advice, if the mortgage company is not requiring flood insurance, that means that you're in a lower risk flood area. So many of us, unless you know you're in a high risk flood zone and it was mandated by your mortgage lender, most folks here in Connecticut, flood's not even on their radar when they're coming in for a consultation. And that's an okay thing because generally the risk, unless you're down by the river or by the shore and you know you need it, your risk is minimal. Therefore, where that helps is that your pricing on flood is actually low cost. So although you have really low risk, insurance is just basically, it's based on a law of large numbers, right? So if you have minimal risk, then your cost is generally lower. So it's not a bad conversation to have. I would encourage that type of conversation with your agent or certainly with your company. But if you're in a flood zone, it's going to be required if you're looking to acquire a mortgage. They're going to indicate that right away. Generally, that's listed on a real estate listing as well or disclosure. And it does get tricky. It's definitely an additional cost. It is all federally regulated. So the FEMA program regulates the rates. So if you're going from company A to company B, that rate should, in theory, be the same. It's really just who's servicing at the end of the day.
Sure. Yeah, I know. I had this with a client where all of a sudden they were told after years of owning a home that now they're in a flood zone and now they have to buy this policy. But it was pretty expensive. I think it was like a couple $1,000s a year. And so they were looking into ways they could, I guess, deny that they need it. Is that anything you're familiar with, or contested, I should say, that they're actually in a flood zone?
Yeah, there are ways that you can contest. Every scenario is a little bit different. So I've had folks that have had brooks going through their backyard, but they're elevated, and that brook is never going to be a real issue. But that's not the way that the mortgage lender sees it. And they're the ones that have a vested interest, obviously, in the property. So yes, to answer your question, there are some tactics that can be used. Elevation certificates are certainly a tool in which it's determined as to what your actual elevation is, whether or not you'd even be impacted by a flood. Because bear in mind, a flood is defined, basically, to simplify, you've got to have your house, your acreage underwater, your neighbor's house has got to be underwater. And so there's areas that may have a brook going through their backyard, but if they're elevated, 100 feet from that brook, the chance of that flood reaching their property is minimal. But again, every situation's different. And I've definitely seen deals fall through from a real estate perspective. I've seen it fall through because of the need for flood insurance.
Yeah, it can be really expensive. I know I looked at buying a rental property a long time ago. It was only for a couple $100,000, and the flood insurance was going to be like $6,000 a year or something like that.
Yeah. And if you're not expecting that, it's just one of those other unexpected costs because, as you know, there's so many different layers to new acquisition, acquiring a new home, taxes, and then all the realities start to hit when you see it on the mortgages, disclosures, and the HUD. It becomes different, and it can be a challenge, but yeah, absolutely.
So what about like jewelry, collectibles, boats, antiques, like golf clubs? Are these things covered under your homeowners if you lose these things or they get stolen?
Yeah, good question, because there is coverage under most homeowners policies. There's just general coverage for those sorts of items. Again, many of these companies have enhancements, features where they've increased limits for those types of personal property. Now, we play golf. And you know how expensive golf clubs can be, especially if you're going to go get custom clubs. And maybe especially when you're looking towards retirement, now you want to go get the special measured clubs and all the club fittings and all these other things. And that can add up. So say you have a $3,000 golf bag and it gets stolen from a golf course or, from a bag drop or something like that. Under a normal situation, you may not have enough coverage to replace that set of golf clubs in the golf bag. You can schedule that item onto your insurance policy, and it's actually very reasonable with most companies to do that. But the same goes especially for jewelry or those types of items where it's difficult to identify the value of those items to begin with. Then there's going to be special limitations on those sorts of items because it is a really popular thing to have happen where you lose a ring or a ring gets stolen or a gemstone falls out of a ring. And these things can all be easily addressed by actually identifying the item, scheduling it on the insurance, or adding a floater of insurance coverage where you actually pay a little bit more money to have the items listed so that in the event of a loss, you can get full value, or at least you can get value for the item if it's stolen, because there's limitations on these insurance policies for those types of losses.
Yeah. So I think if someone does have a lot of jewelry, they probably should inventory it and maybe even get some of it appraised, the more expensive pieces, to then make sure they have adequate coverage either through their homeowners or go out and maybe get a separate jewelry policy, right?
Yeah, those are options. And there are providers specifically for jewelry policies on their own. You can schedule it through your homeowner's policy as well. Many of the companies would look for an updated appraisal. So again, this is one of those things where if you bought a gold or diamond ring 20 years ago and it was listed on the appraisal for $5,000, well, that amount may have appreciated since then, because if gold costs have gone up, then the cost to replace that item may have appreciated. So I know I don't want to have the conversation where I'm telling my wife that, yeah, you had a half a carat before for your diamond ring, but now you've got an eighth of a carat because I didn't insure it properly.
Who are you kidding? You're going from probably 5 carats to 2.5.
No, definitely not.
Well, that's what you told her. No. Okay. So let's just briefly talk about the different types of ownership that your home could be in. Probably most married couples, they own their home jointly. But what if they had their home in an LLC, or maybe they're doing some estate planning and they move their home into some type of a trust? How could that impact your coverage?
From a coverage perspective, you just want to make sure that you have that conversation and that you know how it should be listed. So if you're meeting with an estate planner or an attorney or a financial advisor and you're putting a plan together, you should definitely be speaking with your insurance agent as well, so that the policies are set up in an appropriate manner and that your liabilities are addressed. I have run into seen scenarios where, what we're really talking about here is paperwork and making it an appropriate setup. And we don't want to see an insurance claim denied because the policy is not set up appropriately in the right name.
Yeah, like you claimed it out of your name into a trust, or maybe one of your kids or whatever for estate planning. Then you need to make sure you look at your policy, because it might not cover it anymore if it's not titled properly, right?
Well, you want to make sure that you have the dialogue with your agent or company to inform them of those changes. And they're very easily addressed. And in the state of Connecticut, you have the ability to set it up that way. It's not really an issue, but you need the insurance to be appropriately set up. And it's a very easy adjustment. But if you don't know what you don't know, if you don't know to have that conversation, if you haven't been encouraged to have that conversation, it's just another reason for the agent and the company to do their jobs and set it up properly for you. When it's set up that way, either in a trust or if you're going to be set up so that you're a life tenant of a property, which just basically means you still live in the property, but maybe your children are managing the trust or the estate and you still have rights, and the insurance companies can set you up so that policy still essentially the mechanics of it still make sure that they protect you. But it's also going to bring into the equation, it's going to bring whoever is in control of that trust or that estate needs to be listed as well. All right. So you've got protections as a consumer so that you can live in the house and things kind of function the same way. But technically, you're not the legal owner of that house anymore. So that legal owner needs to be listed on the insurance policy.
Okay. Makes sense. Well, I think that's a great place to stop for this week. Be sure to tune in next week when Matt joins us again to talk about car insurance and umbrella insurance and how you should set that up to make sure that your assets are protected in retirement. If you are enjoying this podcast and you haven't left a review on Apple Podcasts, I'd greatly appreciate you doing so. Please pull out your iPhone, go to the iTunes app, search Retire with Ryan, and leave me a review and a comment. Look forward to talking to you next Wednesday. Have a great week.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.